Thank you very much for having me back, and of course I have my colleague here, Kent Sowards, who probably knows more about the system of support for the public schools than do I, so I brought him along to make sure that I didn't make any humongous mistakes there. Just a few things by the way of background. That's who I am. I did officially retire from Marshall in January, but they let me hang around, and all emeritus means is that you're old and out of date, and it doesn't have much to do with merit, let me assure you of that.
And don't get paid.
You don't get paid, yes, but you do get a parking pass, and that's very, very important on our campus. Just to let you know a little bit about myself, that so that you don't think that I'm totally unqualified for what I'm going to be talking about today. I am a member of the West Virginia Property Valuation and Training Commission and have been for a good number of years there. I'm also a member of the International Association of Assessing Officers, which now operates in 80 different countries. And I do hold the designation of Assessment Administration Specialist. Those are the correct letters. It is AAS, not ASS, as some people have suggested. I'm a senior instructor in courses in property assessment. I serve on their committee on excellence in assessment administration. We're the ones that set the standards nationwide and internationally for what is and what is not quality assessment. And I am also an accredited appraiser. And as you know from my previous appearances, I was on both Governor Underwood's and Governor Manchin's tax projects. The reason I bring this to you is to emphasize a point that sometimes gets overlooked. What I have done is I've shown state revenue and the various major sources of state revenue. And then at the bottom, I put property taxes. And the thing that you notice very quickly is that property taxes are the second most important tax in terms of revenue raised in the state. They're, other than the personal income tax, which is by far number one, property taxes are important. And I have to stress that they are important because if you look at the tax bill in the state, they are number two as a single source of revenue. And also you can see how they're broken down. We don't have any class 1 property anymore. Class 2 is residential property, owner occupied, but the bulk of the property tax is paid by class 3 and class 4 property, which of course is basically commercial and industrial and utility property. So most of the property tax burden is not on the households, but is indeed on the commercial interests in the state. Okay, you can see the breakdown between personal, real, and then the public utility, which is centrally assessed property that is there. And you can also see that the schools are the principal beneficiary of the local tax. They get approximately 65, 2/3% of the property tax goes to the schools. Counties are second, and I should point out that so far as counties are concerned, this is almost the only source of revenue that they have, which makes it very difficult for counties, and rightly so, to be very enthusiastic about having to carry on additional functions if they don't have the revenue to come in to support it. Municipalities do not rely as heavily on property taxes because they have gone to other sources. And of course, the state gets a very small amount of money to administer the tax. What am I going to talk about today? Well, the first one is assessing and charging for digital maps. I then want to say something about tax-exempt real property because it is an issue in the state. Make a little mention, even though I know you've had some sessions on this already, is the taxation of severed mineral interest, and then conclude with some comments about K-12, the public school support program, and the sales ratio study. So we'll begin, and at any time you want to interrupt me, please do. That sometimes works a lot better than having me just go on and leave you in the dust somewhere. I want to talk first of all about something that's been kicked around for a long time that needs to be taken care of, and that is access and charging for digital maps. Almost all property in the state is now digitally mapped, and I have a big, huge mistake on my second bullet point, because the code now covers access and sale of paper. That should, instead of digital, that should say paper maps. But it does not cover access or sale of digital maps. And yet all of the counties, some of them still haven't finished the process, are supposed to have their records in digital mapping form. Nothing in the code is said about digital maps. Can you charge for them? What is the public access that is going to be allowed for them? There's no uniform policy at all. Now, Senate Bill 498 passed the Senate unanimously without debate, but it died in the House. The only change that was of any significance in the bill was to make digital maps, put digital maps on the same basis as paper maps, so that local authorities, local assessors could know what they needed to release and how much they could charge for the digital maps. So the Valuation Commission has repeatedly advocated this type of legislation, and so I think it is fair for me to say that this is something that the community of assessors is pushing for, to try to get this problem solved once and for all. So I certainly commend to you, on behalf of the Property Valuation Commission, consideration of bringing back 498 and seeing if we can get it passed. The next thing I want to talk about is tax-exempt property, because we have a lot of tax-exempt property in the state. This is property that has to be assessed, value has to be put on it, but no taxes can be collected. The Supreme Court established, as you're probably aware, the two-way test, and that is the organization must first own the property, what about leased property, and has been granted a tax-exempt status under Section 501c3 of the Internal Revenue Code. Now, there are other parts of the Internal Revenue Code which also pertain to exempt property. They were not specifically mentioned, though, by the court. And then the real property has to be used exclusively, and that's a key word, for charitable purposes, and is not leased for profit. Now, some of these terms are, despite the fact that there are literally pages on this subject, these are not well defined, and as a result of this, they are not uniformly done or uniformly assessed from county to county. And just so that you'll know what the tax code says, didn't get it over here. First of all, here are some of the properties that are exempted. You run into a problem with used exclusively for divine worship, and I'm going to mention that in just a little bit. These are some of the properties that are there. I got a little ahead of myself. Exempted property, electric, utility, and water property, economic development, belonging to a benevolent organization, which is not defined, houses of refuge, mental health, orphanages, children aged, friendless or infirm, not conducted for profit. Profit is not well defined at all. And then, of course, we had the issue about the summit. And I should point out that even though the summit is now exempted by the Constitution, it does pay a 1.5% gross receipts payment in lieu of taxes. Okay, if I can go back to the terms that are not well defined in the code. First of all, charitable. What is a charitable use? Because property may be nonprofit, but it may not be charitable. And that's where a lot of people get confused. Secondly, it has to be used for an exempt purpose. So it's not just to be charitable, but it has to be used for an exempt purpose. Used exclusively. Exclusively is not defined, and the courts have given us no guidance on it. And it has to be used immediately. And that is, future use may be charitable, but that does not qualify for the exemption unless on the date of assessment it is actually being used for charitable nonprofit. And then, of course, the last one of all of these is that what do you mean when you talk about profit or nonprofit? Okay, there's a big but in this. Seems like it's pretty clear. Well, it actually isn't. But here's the big but. And the big but basically says, and you can read it there, it says, well, we've come up with all of these exemptions, but guess what? Maybe, maybe not that they're exempted. What about property that is held by a charitable organization? What about the dividends, interest, rents, or royalties derived therefrom, used primarily and immediately for the purposes of the corporation or organization? And that is the clause that is giving the most pause, because most of the charitable organizations, well, a large number of them, particularly hospitals and education institutions, have what we call auxiliary enterprises, which they own, which contribute income. But does that make them tax exempt? Some counties yes, some counties no, and we'll talk about that a little bit later. There's your definition of charity. That definition has been around practically, I was able to trace it all the way back to the 1930s, basically without change. And so that is a definition of charity that is used, but again, it leaves a little bit of question, and it probably ought to be updated. But I only bring it to your attention to let you know that we are operating under a definition of charity that came out of basically the Depression period, where there were a lot of institutions that were furnishing relief to the people who were unemployed or otherwise dispossessed during the period of the Great Depression. The next term is nonprofit. Again, you have it defined in the code, and of course the code is again not clear on this point. It says charities and other operating property not used for profit are not precluded from exacting charges upon beneficiaries for services rendered, and are not precluded from dividing profits from total aggregate operations of or from individual beneficiaries on a case-by-case basis. And this gets where we're talking about the total aggregate. What do we mean by total aggregate? Well, again, it's not well defined. Okay, just some of the results. We ran a survey a few years ago, and we found out that the law on exempt property is not being uniformly applied among the counties because of the ambiguities and inconsistencies. And the majority of the counties, barely, do not exempt church parking lots, even though the revenue goes exclusively to support the charitable activities of the church. Now, this is surprising because if you have a hospital parking lot or even a for-profit flower shop or gift shop that operates within the hospital, those are exempted. So you've got an immediate inconsistency here. A fraternal organization that has a restaurant, bar, and dance floor, it's in competition with local businesses. 75% said that they would exempt the entire building. Well, the standard here is what is the primary use of the property? And that's usually done on a square foot basis. But 25% would tax the fraternal organization's property, even though the tax department has made it clear that you are not supposed to split a single piece of property between charitable and non-charitable uses. Only a very small proportion of the assessors would exempt a retirement village if the residents had to buy their quarters. But almost all of them would exempt just the health care portion, even though it's fairly clear that you aren't supposed to be splitting property. And also there are issues about retirement villages where the people pay a fee, or they own their own apartment, they own their own cottage, what is exempted and what isn't. A recent issue, which if I can get it to change there, this is the one out of Harrison County. A nonprofit hospital was building a new facility which was not completed on the date of assessment. Now, you can't build a property like that in 1 year, but it was not open for business on assessment date. Therefore, according to the county assessor, and I think the assessor read the statute correctly in this case, it was not being used for a charitable purpose at that time, so a several million-dollar property tax bill was placed on that new hospital. So the question is, should an unfinished building be taxable, even though it is not being used exclusively at the time? So I merely point these out to let you know that there is a major issue with what property is exempted, what property is not exempted, and there is not consistency among the counties as to how the local authorities are defining those exemptions. And so it's very important that we focus upon what is exempt and what isn't, particularly since the assessors, have to go ahead and tax the property, assess the property, but they can't levy any taxes on it. The idea there is if the property would ever change use, you need to have, or ownership, and is no longer used for a charitable purpose, you have to have a tax base to place upon it. Many states have taken care of this problem by passing what are called pilots, property payments in lieu of taxes. This is what happened with the summit down there in Raleigh, I think it's Raleigh, no, Fayette County. And but we don't have this sort of legislation in place to take care of these problems. Now, the next thing that I want to turn to, which is even more of an issue, is property taxation of mineral interests. And I know that you have had discussion of this before, and if you're having trouble going to sleep, I'll be happy to recommend to you my latest book, which got published in March, which is actually on this specific topic of property taxation of mineral interests. And to begin with, the issue is, what about severed mineral interests? Because this is the predominant, as my last bullet point points out, the estimates that I have seen, and I can't confirm this figure, is that as much as 90% of the mineral interest in this state have been severed from the surface interests. So you've got the surface interests, and then you have severed away from those surface interests the underground mineral interests, coal, natural gas predominantly, but any other minor minerals, and we do have a few that are also, those interests are severed and are owned by someone else. Now, quite often, the severing of the mineral interest took place decades ago when the property was first sold. And so it has been split. The ownership of the severed mineral interest quite often has been split among sometimes dozens, and in some cases even hundreds of severed mineral interests, which lead to a problem I'll be discussing in just a moment so far as taxation is concerned. But I do want to make a point that I think has been made repeatedly, but it is important to make it again. In the future, taxes on minerals are likely to be a less productive source of revenue for state and local governments. And this is going to be a problem, particularly for the local governments, as the mines shut down, as the personal property for those mines, the drag lines, the trucks, and everything else leave. You are already having severe problems in particularly the southern counties, coal counties, from this loss of the tax base. Now, I'm going in the wrong direction on these, but if you notice, the top point is West Virginia now has the highest taxes on minerals of any major mineral producing state. When you add up the severance tax, the property tax, the corporate income tax, and taxes for remediation of legacy mines, you wind up with a situation where we do place a heavy, now I'm not saying it's too heavy or it's too light. All I'm doing is trying to point out that of all the major mineral producing states, we do place the heaviest tax burden on mineral production. And this, of course, means that what we're going to have in the future is what I have called the double whammy. Because if you remember back to your previous discussions on how severance taxes are actually assessed and levied, the property values on the mineral reserves are determined by the state property tax department, and they are provided to the counties. The valuations are determined using a formula with which I think you're now familiar, which is similar to how fee appraisers would value a mineral property for investment purposes, and it uses a discounted flow methodology, where you discount the net income that's anticipated by an interest rate called a discount rate, which is determined by the state. Now, the important thing to note, and I can go into that in more detail if you wish me to later on, but the two most important drivers in that formula are the prices for the minerals and the discount rate. Because even though they're averaged, as prices go down, obviously the valuation is going to go down, since prices are a determinant, the major determinant along with production, of what the income is to be that is to be discounted. The other thing is, discount rates have been extremely low. As you're aware, the Fed keeps saying, well, we are going to raise interest rates. They haven't done it yet, and I'm not sure, I don't want to guess when they will, but they've been at all-time lows. What happens is that as the discount rate goes up, the value of the property goes down. So your double whammy is falling prices, rising discount rates are going to mean that the property, even though it may still be in production, is going to experience a diminution in its value. So we've got to be prepared for the double whammy, both at the state level, with the, less so with the severance tax, but certainly more so with the property tax. Okay, now what are some of the issues here? Well, the first one is that we have really two separate systems, one for natural gas and one for coal. Of course, coal has been around for a long, long time. We have a very well-developed code on code and rules on code. But one of the things that may be surprising is natural gas has been the stepchild in this process until fracking came along. They're not collected in the same manner. And here we deviate from practically every one of the other states. Property taxes on several severed mineral interests on coal are collected from the operator, and they're subtracted from the royalties that are received by the owner. Property taxes on severed interests on natural gas are to be collected from the royalty owner. This means that because of the dispersion, because the severed mineral interests have passed on through inheritance and through other means, you wind up with some very relatively small property tax bills. Also, a lot of these owners don't live in state. Therefore, many of your natural gas taxes simply go uncollected. It's not worth it to go after them. Most of the other states, in fact, I was going to say all, but I'm not sure, there may be an outlier there, do with natural gas as has been done with coal. And that is, the operator takes it as an operating expense and subtracts it from the royalties. That way you get the money without having to worry about all of these dozens or hundreds of severed mineral interests that are out there. So I want to point this out as something that you, of course, the natural gas people may like it that way, but I think it's important to point out that that you do have an issue here which may amount to millions of dollars of local revenue, which is just not profitable for the counties to go out and collect. Okay, unpaid property taxes, you can pursue them the same way that you can pursue any other delinquent property taxes, put tax liens on them, but when you're talking about small amounts of money, it's not just very wise to spend more money to try to collect than you're probably going to get. So two things here. Again, many of the states which have this issue allow the property, the subsurface property, the severed mineral interest, when the taxes are going unpaid, that reverts back to the surface owner. Rather than saying that these will be unpaid from now until, or whatever happens with property which is never claimed at a sale, and most of these small amounts are not put up for sale, is that the surface owner has the right to claim that property. So, and this is impartial compensation to the surface owner for the disruption that takes place to their property when indeed the drilling takes place. Now I know that they do get paid certain amounts of negotiated money for the use of the surface property for drilling purposes and for distribution purposes, but still, again, you do have a provision in most states which say if the severed mineral interest, if no tax is being paid on it, then it goes back to the mineral owner. Okay, let's make sure that I've gotten ahead of myself here. Okay, now to get to one of the real big ones, and that is state aid to K-12 education. And the reason that we bring this up is that the public school support program, as you all are aware, had a slight $30 million problem that's going to have to be dealt with somehow. We have a very complicated 7-step, well actually there's a lot more because there's sub-steps under each one of the 7 steps, formula that is used to calculate how much aid each one of the county school districts gets. And so by the time you have worked through this 7-stage process, you do come up with an amount that every one of the county school districts gets for basic school support. Now, once you have calculated, the first thing that you have to calculate is the amount of the basic support level that can be raised from the local property tax. And of course, the maximums are set again by law. You cannot exceed a certain mill levy for public school support programs. You can, of course, have an excess levy, and I think all but 6 counties do have, excess levies, which are not covered under the public school support program. So you already have a difference among the various county school districts. Okay, but once you have made the local tax effort determination, what is remaining is filled by the state. Public school support program and other state aid to K-12 is the largest single item in your state budget. Let me repeat that. This is number 1 in the state budget. It takes almost half, and it's automatic. You don't appropriate it every year because the law has established this 7-step formula. It's automatically determined, And whatever the deficit is in each county, the difference between the basic support amount and the amount that's raised from the local levy is made up by the state under the PSSP program. Now, one of the things that developed is that some of the counties, it was discovered, how can we increase the amount of state aid that we get? Well, we can increase the amount of state aid that we get simply by under-assessing property. Because remember, the first step is how much money can you raise locally? Well, if it's the rate times the base, according to the Constitution, has to be 60% of market value. But if you under-assess the property, your base has gone down on which that rate is applied. And so what we wound up with is a situation of competitive under-assessment, or the race to the bottom, if you prefer. And the result of this was that many of the counties had discovered how they could get more money out of the state by undervaluing the property that was used in the base calculation. Now, I've gotten a little ahead of myself again, so let's put this up. Under Article 10 of the state constitution, all taxable property is to be assessed at 60%. The 60%, whether or not that is or is not achieved, is determined by a sales ratio study. The sales ratio study, which is not well understood, simply compares the selling prices of qualified property. Not all property that sells goes into the sales ratio study. There are many, many types of sales that are not considered. They have to be arm's length sales that are validated sales. They go into the sales ratio study, and you compare the sales ratio, or the way you can calculate the sales ratio is that you take what was the selling prices of the property compared to what was the appraised, not assessed, but appraised value of the property. And even though this is done as an aggregate calculation, for example, if the local assessor has property where the appraised value, the market value, is supposed to be $100,000 and it actually sells for $200,000, for that particular piece of property, the sales ratio would be 50%. Now, as I said, this is not done on an individual piece of property, but it is done on aggregate by looking at the sales of all the validated properties compared to what the market value was that was being carried on the books, and that's where the under-assessment problem comes in. Now, we do allow, consistent with best practices, a 10% differential. And that means that you can either be over by 10% or under by 10%. So you can be within the range of 54 to 66% and still have a valid sales ratio study. Most of the counties, of course, have caught on to this, and they're now at 54%. Which is right on the cusp of being what is required. But the problem that developed with legislation that was passed in 2013 was to 18911B eliminates the use of the sales ratio study to determine the equalized assessments for PSSP aid. So there's some rather tortured language in there. That tortured language basically says, well, you have to use real sales instead of sales ratio to determine whether or not what the state aid is. And so the equalization portion has been effectively removed from the statute. And you have again opened the door to a repeat of the competitive underassessment problem. Now, I must point out that the state tax commissioner does have the authority to raise the county assessments to the 60% level. It's not mandatory. It's been on the books for a long time. Never happened. They also have the authority to remove either the county commissioners or the assessor if they don't comply. But those of you who are familiar with the issues down on the border on our side know that removing an elected official from office is a virtual impossibility. And so what protections there are really don't exist. And this is something that we need to look at, and that is, are we going to get back into the situation where the counties are going to compete for more state aid by underassessment of property? And I'll ask Kent if he's got something that he would like to add to this discussion.
Well, what I'll add is that the PSSP is a,
Talk right into it.
what I'll add is the PSSP is a basic funding allowance. It came out of a response to the REC decision in the 1980s and over concerns of equity. So primarily what it does is it ensures that a certain level of funding is provided on a per student basis, and that determination is made through that complex 7-step formula, which each one has several sub-steps. The difference, and I think what Dr. Kent was trying to point to, is even though there is competitive underassessment, if the counties are producing less local share revenue, that number that is provided to the students does not change. So then the state is responsible to make up the difference, which in some cases is very significant amounts of money. I don't want to go through the complexities of the PSSP unless somebody really, really wants to know about it. But I think the largest concern that I have is that in a state where assessors are popularly elected and are not required to have certifications to be able to do the assessment through the county, as long as they have the pressures politically to assess in a way that keeps them popular and elected, you have the chance for this competitive underassessment to remain in place.